So our agenda, we talk about the market, treasuries in particular, and interest rates, the economy, the Fed, alternative investments, and then a little synopsis of our takeaways for the month. So jumping right in, the market is at all-time highs. So you may recall we talked about last month that the Fed was likely to do a half point cut, and that if they did that, initially it would probably look like a positive to the market, but eventually it would cycle into a negative. Um, Historically speaking, when the Fed starts with a half point cut versus a quarter point, you have a bigger drop in the stock market eventually. So that's kind of where we're sitting right now. I do see that we could continue to go up a little bit more on the market. Um, Certainly up to the election and maybe beyond the election. But again, historically, when the Fed starts to cut, it takes about 12 to 18 months till the market hits a bottom. So I do anticipate we'll start going down in the market sometime in the relatively near future. So this is a comparison. The first chart is where we were last month. And so you'll see the yield curve inversions are the red marks on the charts. The gray bars are recessions. And so when you have a red mark or short-term bonds are paying a higher yield than long-term bonds, that historically leads into a recession. So you'll see not only are we in one of those red periods currently, it has extended and is spiking beyond even where it was a month ago. So that, at least in my mind, portends that we're having or leading into a significant recession. So one of the things we looked at was a chart that showed what the Buffett indicator is last month. And this is a better description of what that is. So it's the total US stock market value over the gross domestic product of the country. So currently the GDP is shrinking or rising at a rate lower than inflation, and the stock market values just continue to go up. And so as far as the Buffett indicator, things are strongly overvalued. So to dig a little deeper into that, this next slide actually shows where we are. So at 209%, that's more than two full standard deviations above normal, which means extreme overvalue in the market given this indicator. I do think we're going to see GDP potentially shrink over the next 12 months. And if the market stays the same or goes up, the overvalued nature will only continue to rise. That's non-inflation. So they're just showing where the number is today. Okay, so a few months back, we talked about the SOM rule and how it's one of the leading indicators that the Fed uses to determine if you're in a recession. So you'll see the orange bar or the orange part of the slide at the top, and then the blue is the change in employment over a period of time. And so when that number gets above 0.5%, as you'll see, we're there as of August. That's an indicator that we're going into, or actually, as far as the SOM rule goes, that we are in a recession. So you'll see every time that it's gotten above that, it may pull back initially, but then it spikes back up into that percentage area where we're definitely in a recession. So I do anticipate that this will continue to go up as it has in the past. So as far as I'm concerned, we're in a recession. One of the key factors on how I determine whether we want to have more or less money in the stock market is the Shiller PE ratio. So this is the overall stock market index, and looking at what the average years it would take of earnings to equal the value of the stock. So 25 on this chart is kind of the magic number. Anytime that PE ratio gets above 25, we've had a significant drop in the market follow it. So 1929 was the first time we saw it get overvalued to that extent. 2000 dot-com bubble, 2008, 2009, and now we're at the second highest consolidated point in history. So we're a little lower than we were about a year ago, but we're climbing pretty quickly. So you can see last month we were at 34.7. We're now at 36.6. What that means is the market is getting more and more overvalued, which what could happen is earnings outpace the growth in the stock market and that average comes down. But what's happening is the value of the stocks is rising faster than the earnings, and it's getting more and more out of whack. So again, just one more point to look at when determining how you want to invest. So for me, when we get above that 25, we start to pull some of the market exposure off the table. So we're not risking that significant drop. And as we see that market go up more and more, we take a little bit more off the table, a little bit more, a little bit more. So for example, right now, we're taking some of the gains off the S&P 500 index and we're putting it into the short-term treasuries. And we'll get into those charts in a minute. But the short-term treasuries are currently paying 5.5%. So a good, safe yield considering the risk that's in the market right now. So something we didn't talk about in our last call, but what happened basically at the time of our call, the Fed came out, I think the next week, said we're cutting a half point, and that was right at the bottom of this chart. So it got down to, I don't know, 4.1, something like that, yield. And then it's since come up. So just in the last week, we had the jobs number come out, and it was a quote unquote positive jobs number. They came out with a positive surprise. I'm sure you all can guess what's likely to happen in the next month. That jobs number is probably going to get revised down, as every other jobs number has been revised down throughout the year. We had just a month and a half ago, jobs got revised down by 800,000, pretty much erasing most of the gains in jobs that they were claiming throughout the last 12 months. So I do anticipate we'll have a revision. I do anticipate that it will not show up in the broad sense out in the media to the extent that the positive surprise did. So all of that being said, what it did was create a short-term reaction, makes long-term treasuries go down in value, which makes the yield go up. But what we anticipate is the Fed is going to continue to cut rates. Historically, they will cut rates 5 or 6 times over the next 12 months. Once they start, they usually do it for a period of 5 or 6 cuts. And so that trend down will continue, down on the yield and up on the price. So we should see those long-term treasuries continue to go up in value as the Fed cuts those rates. So it's a nice place to be over the next 12 months as we see those cuts come in. Some of you experienced this back in 2008, 2009. What often happens is a sell-off in the market where there's a tipping point, investors get scared and they go sell everything. And what can happen is you have a very short term drop in the value of an asset. So in this case, long-term treasuries, we saw the long-term treasury fund we were using at the time drop by 15 to 20% in a day, just because of the liquidations. And what that means is you're buying them at a discount, you're getting a much higher yield, and you're adding to the stability of your portfolio. What happened in 2008, 2009 was it within a day or two, the long-term treasuries had fully recovered, or at least mostly recovered back to where they were, up 8, 9, 10% from their low, in many cases on the same day. So it was a very short-term opportunity. And so that's an opportunity we're going to be looking for as this market starts to drop. There may be some similar opportunities in gold and silver, where you have liquidations that exceed the purchases, and it drops the value beyond what would be considered a reasonable valuation. So just know that those opportunities may come up, and they may be very short-term opportunities. So on the long-term tips, we had kind of the same thing. You'll see in the chart from last month, the yield was 1.65. It's up to 1.73 now. And you'll see that spike again. That happened right about at the jobs number announcement, and things spiked. The reason that jobs number spiked things was it gave the impression that the Fed was only going to cut a quarter point in their next meeting, which is possible. We'll see if there's a significant revision in the jobs number. Down a quarter point is still a win for us in how we're investing. So whether it's a quarter or a half point, we're invested in a way that it works for us. So again, not to harp too much on this, but here's the 254,000 jobs added, defying expectations. And what that ultimately did was have the outlook for the Fed reduced to 25 basis points, as I just mentioned. So I just wanted to give confirmation of that with this article. That being said, we'll see what happens throughout this month. So no change in the Fedometer. We're still looking at conservative Fed policy. That being said, I think that will adjust here pretty soon. I think we're going to see a sharpening to that easing as we see more and more jobs stability disappear. So one of the things we've talked about for a long time is a year ago, there were about 2 million excess jobs. jobs that just couldn't be filled. There weren't enough workers to fill the jobs, or there weren't workers who wanted those jobs. The excess jobs number has gone down to about zero now. So at some point, that starts eating into the employment numbers, and you start to see unemployment tick up. I wouldn't be surprised with the revisions coming to see that really begin to steamroll over the next couple months through the end of the year. Now, one thing that can be tricky about that is you have seasonal hires, UPS, Amazon, all of those folks do a lot of hiring at the end of the year. And so those might give a false sense of growth that may push the market beyond where it should. Okay, so gold is down from just a few weeks ago, but higher than it was during our last call. I do anticipate gold will, as I said, take a short-term dip when the market comes down, but I think it will get well beyond its highs for this year over the next 12 months. And the same is true with silver. You'll see silver got above 32 an ounce and is now down to around 31. Um, I do anticipate that we'll see the same thing occur as with gold, where we'll see that dip and then it'll come back up. What we've been doing is taking some of the gains on gold and silver, again, potentially looking at getting in at a lower price when we do have that potential dip in the future. Again, taking profits and putting them into the short-term treasuries. Takeaways that we're looking at for this call and through the end of the year is continue to take some of the gains off the table. Continue to move towards those short-term treasuries, again, paying above 5%, and looking for opportunities where we see some of our core holdings, the long-term treasuries, the gold and silver, when we see those drop to prices that are unreasonably low, then we might scoop up some shares of each of those at that time. Okay. Well, thank you.